Good evening. This is Ken at Tortoise Capital with a review of the daily swing portfolio. This is a quick summary of where we got to today. We got long with a lot of positions, short with a couple more, and so I want to show how we got there. All right, so we are at stock charts. So let's just navigate to the health check first, just to show you how this gets produced daily. These are some of my various other chart lists. So today was a second day of buying pressure. Just going to adjust my little 5% bands of sell-off. I use that to help me just get a sense of where we are from the absolute swing high. So we're right at about 5% sell-off. The 10-period regression channel improved slightly, but still down. The 30 is extremely wide because of the range of that 30 days. So we'll drag the 10 period. So this marks off 10 days in a chunk. I like seeing the 10-day segments, and that gives me 30 and 60. Now I'm checking the slope of the moving 30. These green dots are the highest highs, and these were local minimums. Came down here to this one. This is getting a little bit better, so we're having some improvement. Notice the 200-day moving average is just sneaking on board here. These purple lines represent price targets on the way up. Those are at the Bollinger Band mean. This was the top of that baby dragon. This is at Z2, and this is at, I need to slide that up just a little bit. This is at the top of the dragon. On the downside, I'm looking at a one-day low. This is the belly of the dragon. So that really, to me, is the channel from 284 to 264. Swing low over here, and another belly of the dragon. So those are price targets on the way down. They used to be support, or they used to be resistance, excuse me. Now they could be support if this thing collapses. But we have 2 days in a row of improvement. Now we're getting the MACD histogram. This is where the peak of the downward move, and it started to hook up right in here. Across the 5-period exponential, moved back into the Bollinger Band river on the MACD. It says PPO, but it's really same as a MACD histogram. And this is where it crossed the zero line, briefly dropped below, but is now hooking up, crossed itself again, getting ready to give us a long bias when it crosses that zero line. So I take this as a good thing right here. Now, if we get a couple more days of buying, then this is going to look like a swing low and a higher low in the baby dragon, and then in the dragon itself a low and then a higher low, and that'll be a pattern 4, and off we go. And then the next test is 284, and if it gets above 284, then it's free and clear. So this is a market, although hovering on the edge, right, I mean, you can see it at the 50% marker there on Williams %R, and the ADX is now under 30, and the bulls are catching up. So this is a market that's poised to go in either direction on the basis of the health check. But this looks favorable to me. The failure to fail further, and 2 days in a row of buying pressure after 3 days of selling with a gap down that cleared out everything below. The PSAR is getting ready to flip here after only 3 days on the negative side. So I am cautiously optimistic. I'm about 60-40 in believing that it's the long side right now. Okay, so that's the update for the market health check. We'll save those changes. to save that in my naming nomenclature. (2018-0305), and off we go. Okay. So now this was, it opened at the low and basically was a big range with a large signal, very small noise today. And this is ideal for core and turbo type trading because we're leaning forward because the reward is on the upside. When it takes out yesterday's high, that's a very favorable sign. So the mechanical signal to get in on this one would be right around 270. But because it opens and starts moving up, there may be a way that we can get into SPY intraday with a much smaller risk than we might use on a mechanical entry. So if we took the mechanical entry at 270, we'd be entitled to be down here around 265 or just underneath this support level at 264 under the belly of the dragon. That would be the collapsing dragon. So if I put my position sizing stop down here, I would be on the side of the angels on that one. Okay. So let's take a look and see what happens with SPY. We're going to see this would end up happening a lot with symbols all over the place. So now let me shift back over to a daily look real quick. Okay, so you can see this was yesterday's bar, Monday. So our mechanical entry would be right here around 270.32, and we would have a stop down here around 258 at the belly of the 10. Okay. So now and then a mechanical entry here about 270. Okay. I'm sorry, 264 would be that swing low. So we'd be looking to get long around 270.32 and short around 264.84. So about $6, maybe $5.50 of risk for a swing trade. Okay. When we look at the intraday, take out the overnight market here in just a minute. So here's the market open right here. There's a gap down, and about 45 minutes into the day, or actually about an hour into the day, so this we have the MACD histogram gets narrow because gap down makes this wide. Then it narrows down and then crosses the zero line here. This is where we're entitled to pick up the long side bias. So I buy one here. I'll use Z2 as the swing low. Notice the MACD histogram on the ones. So our intraday entry is 268.48, call it 268.50. Call this one 267.57, so that's about 90 cents of execution risk. And this line here at 270.32 is that mechanical entry that we put in. So if you're using $400 of risk as an example, let's call it $100 of risk. For every $100 of risk, you're buying 110 shares with 90 cents. And the exit you get on and we'll call that the turbo, because you're using intraday levels of risk. The mechanical entry here at 270.32 was using that 264.84, the swing low, the 2-day low there, as the execution risk. And so that's 264. That's the $5.50 of risk. So on $100 of risk, you're only buying 20 shares rather than 110 shares. So you can be 5 times larger on the turbo position because of the intraday measured risk. You're not worried about gaps in here. you can manage this risk. So you can be 5 times as large. And now, on that 90 cents of execution risk, you're going from 268.48, and I wouldn't be offended if you got out here when the MACD histogram line rolls all the way back over, and then you pick up a negative bias right here. That equates to an exit here. Say when it's crossing the RL270, you're approaching that. So 271.38, and you got long at 268.48. So that's basically $2.90 on 90 cents risk. So that's about a 3R execution gain. And if you cash here, now you've earned enough money on that trade to fund the overnight risk on the mechanical entry, which you can get in here at 270.32. Now, as a finesse of this, if you wanted to think about adding a second position at the swing trade entry with using some of this level of risk, that wouldn't be wrong, and you'd have been happy to have done that. It doesn't always work, but you can certainly do that. Or you can simply say, you know what, I'm going to just sell 4/5 of my position here, and now I'm going to keep my swing trade with 1/5 the position, and I just have a better entry at 268.48 instead of 270.32. So there's 3 or 4 different ways you can use money management in order to execute that. And then on the swing trade basis, you have a really nice close all the way through, and now you're managing the swing trade with money that you earned intraday, and so you've taken your core capital, your seed capital, out of the market. Same pattern in the Dow. Let's shift back to the daily. Pardon all these lines. We trade this one a lot. And so here was the yesterday's candle. So the mechanical entry 246.22, range risk, it's also the swing low, 241.92. So the swing risk execution risk would be about $4.50. And then when we look at the intraday, we're going to see essentially the same pattern as SPY. Not surprising, they're strongly correlated. So you have the open, stabilizes right around that same time, 10:30. You get the MACD histogram crosses the 0 line. You can be long then at 244.59 with execution risk of 243.81. So that is 60. That's about 80 cents of risk. And then your mechanical entry at 246.22, and I mean this risk is never even challenged. You could use the Z2, you could use the RL270. You just wait for this signal here when it crosses the line, and now your exit is at 246.95. So that takes you from 244.59 to 246.95, and that is $2.50 on 60. So that's about 4R on the execution risk. And again, you have the option here on the mechanical entry to either add an intraday position or just pick up more shares for the swing, or just say, you know what, I'm going to just use the 1/5 of my position as my swing pattern. And then if you get out here, that's fine. If you are just looking to earn money intraday for the funding of the swing position, I mean, you could be out at lunchtime. But if you wanted to trade more times during the day, you get a re-entry or a recrossing back above the 0 line here. So you could pick up a long bias, get long at 247.34. And again, if you're using, just use that standard, the same risk you had in the morning, so you're not crazy. And so your position size is the same. You get long at 247.34 with a risk of about 75, 80 cents. Oh, that's right. We said that 80 cents. Sorry. And then you make 47.34 to 47.99. That's about 70 cents. So that's about an R. There may have been a cash in here, but you get long again here, 47.99, and exiting here. That would be so $1. Yeah, about another $1.10 on 80 cents, another 1.5 hours. So there's opportunities throughout the day to do more things with that kind of a just using the directional bias of the indices. Okay, I'm gonna stop it right there. I'm gonna go through for the swing course, folks. We're gonna go through all our the positions that I showed you earlier, where we were getting long various things. But in many cases, it's just an additional variation of this when mechanical entries were taken, and you would see roughly the same kind of pattern. So I think you get this major idea. So I'm going to call that there, and then let me shift. While we're here, let's just go ahead and knock out the daily report. All right, so this is daily report for the 5th of March. Bull volatile in the middle of neutral for the annual and the 10-day. Slope of the 200, the price with respect to the 200 is yellow bullish. The slope of the 50 is red bearish. So there's still some longer term weakness because of that sell-off in February. ADX is now under 30. The bulls are catching up, as we saw. The risk index is at 1.047, so we're in risk on. The volatility is quieted enough to give us favorable swing trades on the long side. The z-score of that risk index is, in other words, the risk C is 0.44. Here's that number. This is the 90-day histogram, so this were good long side swing trades in here, and it's favorable. This is coming into the summer of the of swing trades, so that's a good thing. In the middle of the end of the 10-day NDX, no signals in channeling and overreaction. The same usual suspects on the 10-day max pain. These were all long entries today. They all performed very well. And even on an intraday basis, each one of those earned enough money in the turbo to pay for the core swing position. The Dow Tactical, lots to choose from on the auto framer. Walmart, Nike, McDonald's, Disney, Home Depot, DuPont. Couple channelings, 5DD. So Nike's interesting. Channeling, overreaction, 5DD, a max pain, 3.7 on the auto framer, and turned in one of the better performances today, 1.86. So from extreme conditions come extreme results, and that's why I like paying attention to those max pain guys. They all had a pretty good day. The best one being Caterpillar at 3.24. That was an amazing move today. In the let's see. Okay, continuing on the ETF 30, another handful test out well on the auto framer. Mexico, emerging markets, EFA, XLI. Big winners today, oil exploration, and the utilities. Pinch and stretch. The tech leaders continue to lead. Intel, Cisco, Apple, XLK. XLK doing slightly better than the Qs. Brazil in there as well. No super pinches. These are the ones that are getting the closest to being pinched. Things are starting to settle down just a little bit. These are the most negative Z stretches. These to me are interesting as the deep discounted value plays like Walmart, Home Depot, and Caterpillar was a big winner today, and still at minus 1.83Z. Just a quick look at Caterpillar on the daily. You can see it basically the same pattern. It It crosses the zero line here, so you're long at 145.94, so 146, call it. This was the mechanical entry, and then you get you're selling at 151, so $4 in a very orderly fashion. This is kind of the essence of that frog trading as well. So this combination of core and turbo for swing and intraday is a very powerful combination. That's what a max pain range compression trade looks like when it uncoils in the other direction. Right, back to the daily, just finish it up here real quick. Daily pinch and stretch. The auto framer with all the standard mechanical entry framing data. Again, you see Nike, McDonald's, Disney, Walmart, Caterpillar. Caterpillar is still 2.5 to 1 on a retest of the 10-day high. Nike at 3.8. And then the regression line fractal framework, the top shelf in the green. These are the symbols that are the most numbers of ATRs below their own RL270. And these are the most ATRs above their RL270. So deep discounted maybe value plays. And then these are the relative strength leaders. So again, notice the tech. Cisco, IBM, Intel. The daily squeezes, these had tight ranges compared to their average range, and so if they uncoil and break through that mechanical entry, there's room for some real large one-day pops. Johnson & Johnson, Coke, Pfizer, just looking at the Dow 30s, and Disney. Second day of buying pressure. The RL10 has crossed over its own, or I'm sorry, the RL30 slope crossed over its 10-day moving average. Here's a zoom in on that one. That looks very healthy, and potential is there. And the slope of the RL10 found some stability today. The slope of the 30 is improving at an extreme distance. The 90 is still favorable. So this is being seen, I believe, as a bull that stumbled and is recovering but gaining its strength. And I think there's an argument for the upside here, pretty strong one, for returns. However, we will continue to respect our stops and follow where price leads, but that's the trade frames are all pointing towards the north. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.